What's up, everyone? It's County with MoneyVest. It's been a while since I've talked about Enphase energy stock. In this video, I'm going to cover everything. So they reported earnings recently, and I'm going to break down the numbers. We'll talk a little bit about the technical analysis on this stock and what I'm personally doing, how I feel about this company at the moment. Everything will be discussed. As always, if you enjoyed this video and find it helpful, make sure that you drop a like. I would really appreciate that, and subscribe to the channel. And also, the first week of the month is the best time to join if you want to be a part of our Patreon and our Discord. There's 3 more spots left, and of course you will get access to all the members only private videos, including over 50 tutorials and private videos, including our 30 stock shopping list, as well as my buy targets, Enphase included, introducing the MoneyVest index with a very high success rate, and also a lot of other videos that I think are going to be super useful, along with our spreadsheets and, more importantly, our trade alerts, including our investing alerts, trade ideas, options alerts, everything included. And also, we've got a sale going on in the month of May. So for all individual courses, 50% off. So they're all half off on the entire website. So coupon code is going to be May50 if you want to take advantage of that as well. And also do connect with me on Instagram. My handle is going to be CASWRP. So first things first, let's talk a little bit about the numbers for Enphase, which they reported. So if you actually come over to the numbers itself, that we actually did get a miss on both EPS and on the revenue. So we knew that 2024 was going to be a little bit of a struggle and a challenge for solar renewable energy companies. If you come take a look at TAN, that's your TAN Invesco Solar ETF, it's just has had a very significant sell-off from highs of $125 a share. It is now trading at just under 44, a 69% drop, and year to date the stock is down over 17.5%. Not to mention, of course, a lot of solar renewable energy companies. There's about 4 of them to be in sort of like the industry that kind of belong to it. First Solar is the only one that I believe is up 14% year to date. Everything else is performing really bad. We've got Solar Edge down 35%. Enphase is also down, I believe, year to date, a little bit over 11%. And then Sunrun also selling off a little bit over 37%. So really, it's First Solar. I've actually done videos on all these companies in the past, kind of doing a comparison analysis. So make sure that you do check that out. But if you come over to the numbers from Enphase, honestly, I mean, they weren't great. If I'm being completely objective, first of all, I now don't have any positions in Enphase because I did have a couple of covered calls that perfectly got assigned to the buyer because I was selling those calls and my shares actually expired in the money. So if you come over to Enphase, this was around the time where my shares got called away from me. This was the time when Enphase was in the $137, $136 range. It got up to that level and, of course, sold off. I think it was around this time in the middle of March when my shares got called away. Then they sold off, consolidated sideways in that support, and right now we are just under 116. So really, I'm going to be looking to get back into the stock, or most likely we'll be selling puts here, but really just want to touch on the fundamentals first. And the thing is, the revenue came in at $263 million, which was, of course, a decline quarter over quarter, and also a significant decline on a year-over-year basis from $726 million. So really, things are not looking great at the moment for Enphase, as we already knew that 2024 was not going to be great year because of higher interest rates, because of, again, sell-through rates from their third-party vendors and suppliers. I mean, we already did see a lot of softening in demand for microinverters and solar panels in general. Gross margins sitting at just under 44%. So one thing that Enphase was able to do was maintain margins pretty well compared to a year ago. I mean, we only did see a 1.1 percentage compression here for the company. Operating expenses were pretty stable, right? So that's actually probably one of the biggest problems that companies face, is that when the revenue drops this significantly, right? So it's more than 50% decline on a year-over-year basis from 726 million to 263 million. Cost of operations or operating expenses doesn't drop by 50%. I mean, it only went from 158 million to 144 million. So that's why margins will go down, operating margins, and that's why profitability will also struggle, because if the companies dropped their cost of operations the same as the revenue, the margins are stable and profitability can still stay intact. But because revenues dropped so much, they went down significantly. And then, of course, cost of operations or operating expenses did not go down as much. They only went down just a little bit. So that discrepancy there is causing the company to generate an operating loss. And, of course, more importantly, a bottom line net loss, and diluted earnings per share sitting at negative 12 cents per share. which again, same time last year were $1.02 per share. But if you come over to non-GAAP numbers, so non-GAAP over here, same revenue, right? So same revenue decline. However, operating expenses at $82.5 million versus $98.3 million same time last year. There was about a $40 to $50 million stock-based comp that was baked into the first quarter of 2023. Now, here's the problem that I have. When Enphase knows that they're having such a not so great year in a quarter and they're seeing a lot of headwinds, they're still offering a lot of stock-based compensation, right? I'll go over the GAAP to non-GAAP reconciliation and you can see that for yourself. But last year, it was kind of understood because they had a fantastic start of the year, $726 million a year in revenue for that quarter, and $98 million in operating expenses is literally nothing. And then if you look at 158, I mean, we're looking at about $60 million in non-cash expenses, which includes your stock-based comp. That's understandable, but $60 million off of $726 million in revenue, if you do the math, $60 million divided by 726, that was about 8.2% in revenue, right? 8.2% of revenue paid out in non-cash expenses, whether it's stock-based comp, whether it's depreciation, amortization. I'll take a look at that in just a minute. But if you take a look at what they did now, right? So from 82 million to 144 million, I'm gonna assume at least $40 million of stock-based comp, right, for this quarter, divided by 263, that is a 15% increase in stock-based compensation. That's not good. That's not good. I'm going to be objective. I'm going to try to keep it as real as possible. I'm not going to sugarcoat these numbers, right, and just try to kind of tell you, oh, look at that. I mean, they still achieved profitability. They were still good. No, I mean, they doubled their stock-based compensation on a year-over-year basis, while of course hurting the profitability of the company on a GAAP basis, of course. Even though it's a non-cash expense, again, it's a little bit of dilution. It's a little bit of that non-cash expense, which hurts bottom line profitability. Almost $39 million in operating income, and of course $48 million in net income. 35 cents per share was the actual earnings per share. If you come over to the numbers, so this is the GAAP to non-GAAP reconciliation, and I really want you to focus on over here, stock-based comp. And more importantly over here, so after the gross margin, stock-based compensation percentage, and this as a part of their operating expenses, right? So operating expenses, stock-based compensation, and acquisition-related expenses, and amortization, and restructuring, asset impairment. These right here are the adjustments that companies make on their non-GAAP versus GAAP basis. And then if you take a look, right? So if you come take a look on what they've spent, this is on the entire year, I believe. So fiscal year 2023, they spent about almost $200 million in stock-based comp. In the first quarter of 24, $56 million. So it wasn't 40, it was $56 million. So if you do the math, 56 divided by 263, we're looking at a 21%. 21% is what they spent on the actual stock-based compensation here, right? So that's actually pretty significant in my opinion, compared to, let's say, first quarter of 23, which was also $56 million. But of course, the revenue number was much higher. Gross profit number was much higher at $326 million versus $115 million, which again is 67% lower compared to what we witnessed same time last year as well. As you can see, again, 0.5%. Of gross margins here on 1.6% over here. Again, stock-based compensation, we're looking at almost 60 million here and a little bit over 60 million over here as well. Entire last year was $212 million, and the year before that in 2022, $217 million for the company, which of course is now resulting in the free cash flow. So cash flow from operations now sitting at 49.2 million compared to same time last year, which was at 246 million, and free cash flow has gone from 223 million to 41.8 million dollars as well. So really what we witnessed for Enphase, as unfortunate as it is, we basically witnessed a company that saw significant amount of growth over here like that, right, and then stabilize, and then it's now starting to see a little bit of this. What we really want to see now moving forward is that consolidation and then start moving back higher. Now, I know that there's going to be a lot of comments on this video that, Caddy, now you're turning bearish on Enphase. What's going on? Are you shorting this stock? No, I think it's still got an insane amount of market opportunity here to capture over the long term as the world moves more towards solar panels and renewable energy. It's just that I'm giving you straight up. I'm showing you the numbers, I'm showing you the data, and I'm being as objective as possible. I'm not going to sugarcoat it. And it is tough. It is going to be a challenging environment for Enphase and for a lot of these companies. It's really whether they come out of this strong or they don't, right? That's going to be the real question. You can see quarter-over-quarter revenue numbers. Of course, first quarter of 2023, we saw insane jump over 726 million. This was, of course, not the best quarter. And second and third and fourth quarter, of course, we'll see how Enphase performs. It was really the third quarter of last year when the trouble began. You can see the green bars starting to go lower. So we actually started seeing from 711 million. That was the peak for Enphase, then 551, then 302, and then now 263. So we've really just seen 4 consecutive quarters of declines in revenue for the company, and quarterly operating expenses have continued to go up. So again, you can see the green bar here continues to go up, now 31% of the entire revenue number, and operating income also has been struggling. So you can see the green bar here coming down, and now just under 15% in operating income percentage margin here for the company. So really, I mean, it's kind of like a moment in Enphase's history or timeline here, really, I should say, in business cycle where they are starting to struggle a little bit. And really, it's going to come down to how do they come out of this and whether they are able to, once again, move back to GAAP profitability, GAAP earnings, and really keep a lot of these things in check, because they've got an amazing business model, right? Their entire ecosystem is fantastic. I mean, we've got the IQ microinverters, the IQ EV chargers, the Enphase application. I've seen many people use this app, and they've been super happy, and it's been working like a charm. So they do have a very large market share. They do have a lot of, amazing technologies to work with. And the potential is there, right? I mean, if you just take a look at these numbers here, more than 4 million systems in over 150 countries, right? So a global reach here for the company. 2023 revenues, very, very nice, 2.3 billion. Our customers are distributors, installers, and homeowners, 1750 installers in the Enphase installer network as of March 31st, 2024. Cash flow from operations in 2023, just under 700 million. Again, GAAP, non-GAAP net income was also solid last year. So everything's good. It's just, how can we make it even better? And right now, of course, the business is struggling. I think over the next couple of quarters, we are going to see some issues with Enphase moving forward. So if you come over to earnings estimates, and then if you're looking at 2024 numbers of, let's say, $2.91, that's a 34% decline for the company. If you come over to TradingView statistics as well, so if you come over to earnings estimates, we're looking at 291. So that is a compression from 441 down to 291. And if you do the math here, if you come over to our model, so 5-year DEM, 291, so we're going to plug in 291 multiplied by the shares outstanding here. We're looking at a number of about 397 million. So $400 million in actual profitability for Enphase, right? So ENPH, let's plug in 400 million. We're going to go with a decent growth rate of, let's say, 16%. If they're able to grow net income, even though they're going to drop this year by 34%, then pick right back up. That's what the market's expecting, 75% increase in year-over-year earnings. And even you can see over here, they're accelerating 512, 619, 715, right? So we're seeing that acceleration happen post 2025. The expectations are that, okay, interest rates are also going to be coming down. So 16% growth rate, let's just give them a 22 to 24 times PE multiple, 12% discount rate, 10% margin of safety. By no means are going to be doing 5% share buyback. So unfortunately, I'm going to have to plug this number down to 0%. And as unfortunate as it is, we're looking at a fair value closer to $75. Now, again, things will change, expectations will change. So not saying that this is set in stone, that this is exactly where the fair value, intrinsic value is. Of course, if the company is able to grow faster at 20%, then we're looking at sub $90. And if they're able to, let's say, grow at 25% with a P multiple closer to 30, you can see that they would already be undervalued with a fair value of $137. So it really depends on where you're comfortable kind of pricing that stock. Given that expectations are coming down and we're already starting to see some GAAP losses here for Enphase, unfortunately, I'm going to have to go with some lower numbers. 16 and 25 times P multiple, sub $80, I think would be a lot better. And this is going to be that sensitivity grade that you can take a look. And if you come take a look at the technical analysis, you can see the lower highs and the lower lows, and support level down at $91, but a much better buying opportunity for me is going to be closer to $79 to $80 per share, which I know may come as a little bit of a shock and a surprise to some people. But look, this is how markets change. Expectations change. Circumstances are constantly changing. So for Enphase, of course, things can change in the future. If things get better, earnings expectations are higher, growth rates are higher. Yes, intrinsic value is also going to readjust to account for that possibility. But as I've always said, pay low, prices you pay determine your future returns. So always expect to pay less. Always negotiate. Always look for discounts. Always look for a deal. And that's how you can almost be certain about profitability and good returns in the future. So for me, Enphase is still very much in the context of a downtrend, kind of tagging up to its 200 SMA, still very much at that support. If it ends up selling off down to $92 or $80 a share, I'll be looking at selling puts here for Enphase. And a resistance, a very important resistance that I want to highlight, and a target and a supply is going to be at $130. So that is going to be that level. We've gotten rejected at that price multiple times, and resistance all the way up to 151. One last thing I want to mention is that when a business is going from great to not so great to good and to bad, of course stock price goes down. But when a company goes from like bad to not so bad or decent, then the stock price has huge upside potential, because it isn't always that stock price goes up when the company is going from good to great. It's also the stock price goes up when the company or the business is going from worse to bad to okay, right? So if it's less worse of a business, the stock price can also have huge potential and move back higher. And I think Enphase kind of went from being good to a great business to now being not so great. So if it once again achieves that good to great status, there is potential for this company to once again recapture 140s, 150s to possibly back up to $200 over the long term. So let me know your thoughts down in the comment section below. And again, don't forget, join our Discord, join our Patreon if you want to be a part of our MoneyVest community. Access all the 40, 50 plus videos and tutorials, and also all the individual courses, 50% off, coupon code May50, available until the end of this month. And as always, happy investing. I'll see you all in the next video.